Hey guys, Adam Rose, Vice President, Senior Loan Officer for Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy Podcast. Today we are going to touch on what's going to be happening at the Fed. So we're going to try to get this out there so you can all educate yourselves on what might be happening in the mortgage market, right? The rate market, not necessarily the Fed funds rate. And we're also going to talk about a lawsuit that recently hit. There's a bunch of lawsuits going on out there, but this is kind of an important one. And it's a relationship that's not really monitored or regulated heavily in our industry. And it's something that is a cause for concern that we've discussed before. But nonetheless, let's hop into it. So first thing I want to talk about is this RICO suit that hit a pretty big builder. And I hate to name them, but they're a national builder, so they'll survive. But D.R. Horton, unfortunately, with DHI Mortgage got nailed with a suit. A racketeering scheme, basically, is what it's being sold as. Now, just a little background. So, our industry is heavily regulated. We have RESPA Section 8 is one of the biggest things where, if I have a referral partner, I can't give them a thing of value in return or for that client. And sorry, I'm all around here. This is our Christmas episode, I guess you could say. Got a bunch of Christmas gifts I gotta deliver to some offices today as I talk about giving a thing of value. Awesome. But anyways, so that's a RESPA violation, right? Section 8 of RESPA. Now, one of the, you could say, pieces of the industry or a specific segment, right, that's not regulated, is the builder-lender relationship, which, a lot of independent lenders out there, if you don't have a relationship with the builder or you're not an in-house lender for a builder, you can't typically touch the offers that are coming through. There's a perfect example here in Sydney. Ryan Holmes has a relationship with their in-house lender, and so there's deals that they can do back and forth that, typically speaking, I can't offer, or the majority of lenders can't offer or match. Hey, you go to a builder, and they say, hey, if you use my lender, we'll give you, example, $7,000 worth of upgrades for your house, right? Or, hey, instead of upgrades, they'll buy down your rate by 1.5 for free, or whatever the case is. All right, that's not a specific example, but that in general, that's kind of how it operates, right? Which we can't do. And that's kind of the thing with this. Is not necessarily them giving back to a client or a RESPA Section 8 violation, but what it is in order for DR to show a little bit more of a suppressed payment, they are not qualifying buyers. Well, they might be qualifying because I can't see the loan application, but they're selling the idea of a suppressed payment using the tax values on the vacant lot, not the expected assessed value once the home is constructed, right? So when we do new construction loans, we have to get with the title company and the county treasurer's office to say, all right, here's our estimated valuation of this home. What is this tax rate going to look like? Oh, it's $600. All right, that's what we're going to qualify this buyer off of. That's what we're going to illustrate our payment as. Now, that doesn't mean when you go to closing, that's what your payment is going to be, right? Because I can't collect that much in taxes because that's not what the current tax bill is, right? So your payment is going to be set up with what the current tax bill is, but you cannot or should not illustrate using $10 a month in lot taxes for your qualifications or selling that to the consumer that their payment is going to be that low. The reason this case come about is because it sounds like that practice was happening. And buyers, and this is the example, so plaintiffs argue that the practice misled FHA and conventional borrowers, qualified borrowers for homes they couldn't afford, okay, and led D.R. Horton market lower monthly payments, okay? It let D.R. Horton market lower monthly payments. So some borrowers reported increases of several $100s to over $1,000 per month because the consumer was not aware that the taxes were, in fact, going to be reassessed once the home is built, which is usually the following year, right? Just depends on your county and how much they need the money. But that's what happened there. And so there's a RICO suit going through on D.R. Horton, and that is a massive nationwide builder. And that'll be tough to get through. I'm kind of interested in seeing what happens there. But nonetheless, the most important stuff is, before I get to the Fed rate cut, just an announcement. People that follow this, if you are a mortgage banker, if you're an insurance agent, if you're a title company, if you're a vendor in the industry, and you are not a member of OMBA, make sure you join we did just release our Future Leaders program, which will be on March 3rd, 4th, 10th, and the 11th will be the visit the State House. That is a fantastic program. We've got some high caliber speakers that will be teaching those classes, so I highly encourage you to jump on there. And the last thing is we just released our registration for the annual convention that'll be in June with some amazing speakers as well, and a great time to collaborate with everybody in the industry. So if you are not a member, I highly encourage you to do so. And even if you are not directly in the industry, like I mentioned, a lender, title company, something like that, which is really hands-on, but a vendor member that provides tech, lead gen, insurance agents, you name it, it could be very beneficial for you to join this organization so you can mingle around, network with some people, and pick up some additional business and learn a lot as well. So let's hop in to the Fed rate cut. All right, so it is expected keyword, that on Wednesday, whatever the day is, the 10th, that the Fed is expected to cut the rates, possibly a quarter of a point, okay, to get them to the target range of 4.25 to 4.5 on the Fed funds rate, okay? But that's not really the story. The two things that we've got to look for here is the dot plot. So what that means is, where are the rates expected to head, right? Not just what's happening today, but the expectations on not where the Fed chair necessarily thinks, but the group, the Fed members as a whole, going to plot out what 2026 might be showing and how many rate cuts are going to be there. That is going to be the big tell in regards to the confidence level in the market and what's going to happen with the Fed funds rate. It's also, as I've talked about before, on the last Fed cut, rates have went up since the last Fed cut in November. Okay, I think it was November 7th or 10th or something like that. They've been up 30 basis points since that Fed rate cut. And I talked about it because, we're very speculative. So when we expect a Fed rate cut, we have already baked that into the pricing. So you might see prices lower or mortgage rates lower a little bit during the first couple of weeks leading up to a rate cut. Because remember, mortgage rates follow the 10-year Treasury. That's the key. That's the indicator. That's the leading indicator of what we follow. And when the cut happens, usually we flatline, don't change much, but we're also looking for tones, right? I say we, but the industry as a whole, the Treasury market, right? The bond market. I'm not over here dictating what's going to happen. I'm just trying to educate people on what might be happening, because here's what I know. I know if the Fed cuts rates at 2 o'clock that I'm going to get a ton of phone calls asking if we can get a lower rate, and the answer is most likely going to be no. And the reason is because of the tone of the Fed chair. So like I mentioned, when they cut rates in November, Fed chair is like, yep, don't think we're going to cut anymore. And that alone moved the bond market in a direction that we did not want it to go. All right. So that tone and their expectations, they're going to be a bigger leading indicator of what's going to happen in 26 and what's going to happen in the future than anything at all. But the expectation of an immediate rate cut in regards to the mortgage rates is highly unlikely. The expectations from the Mortgage Bankers Association is that rates are going to stay in the low sixes the remaining of the year into early first quarter of next year. Again, seeing what they say on what they're expecting for next year is going to be the biggest indicator on new expectations, where they're going to go. Are they going to go into the fives pretty easily? What's the situation? So we're going to have all eyes on Fed Chair Powell today, and I'm very interested, but that's why. You hear the Fed rate cut, you think mortgage rates cut, it may not. Okay, so just FYI, I hope this information was helpful for you. I want to make sure all that information is out there for everybody to see, so you're not constantly blowing up your lender or complaining that you couldn't get a lower rate even though the Fed cut. As we've educated people, that is not a direct correlation. Okay, so remember, subscribe on YouTube. Check us out on Apple Podcasts, Spotify, and we will keep you all up to date with these market updates. See you next week.